Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I would like to do today is look at 5 companies that are dividend paying companies that potentially be a good buys for the month of March. We always do this every single month, and I've got 5 that are undervalued, 1 kind of fair valued at the moment, but the other 4 definitely undervalued according to Morningstar. We'll check that out first, and then what we're going to do is give you just the Sharia compliant side of things at the end of the video. As you can see here, this is my current portfolio. As you can see, is £99,000. Alhamdulillah, it's great. It's actually gone down a little bit since yesterday. I think yesterday was almost £99 or £100, but it's absolutely fine. It's because the markets are down a little bit today, and Broadcom has reported, so I'll be yesterday, so I will be checking that. Inshallah, I'll give you more details of where it is. In fact, because today's down 2.5%, I'll let you know what the plan is for that one. So anyway, so let's get started and look at the 5 companies. But before we do that, as always, I would like you first of all to subscribe to the channel and press that like button, and of course that notification so you don't miss when we post any videos. At the same time, if you can join us in the Patreon account, it will cost you about 50p a day if you join us and pay that £4.50 basically per month. That would be really wonderful, and you get access to the buys and sales that I make. All the brothers out in there, they're also buying and selling stocks and sharing that with each other every single day. You get access to the dividend trackers, you get access to the Sharia compliant investing ebook. Inshallah, there's a lot to gain from it, so trial it for 1 month. If you don't like it, of course you can always leave, but it would be wonderful to have you there, inshallah. So as always, please make sure that you are doing your own research. Again, this is for entertainment purposes, and if you like any of the companies, make sure you do your own research, inshallah. As always, we are looking for the company name, the market cap, the moat. The moat part is quite important to me because it shows me this company has a that competitive edge that basically needs to protect its customers so they don't go to any other companies and so on. We're looking for the price, we're looking at the dividend yield, the payout ratio, latest increase, the 5-year growth rate, dividend streak, annual payout. We're looking at the safety side of it according to Simply Safe Dividend, profit margin, return on equity, and return on invested capital. This kind of helps us understand how profitable the business is and what the company is doing, what the management of the company is doing with our capital and the money they receive. Are they reinvesting? Are they making more money for us? Free cash flow, we want to see if the company is got some to, of course, pay off any debt, pay that dividend, increase in that dividend, of course, buying back other companies, and just to reinvesting in the business, anything like that. Total return the last 10 years, we want to see where the companies have been over the last 10 years to give us an idea, of course, to see where the company is heading. Growth estimate for the next year as well. We want to see, is this company basically projected to have some sort of a good growth in the next couple of years and the next 5 years as well? So the next year and then the 5 years that follow up every single year, what are they expecting? Again, this is estimation. And then Morningstar valuation. So where do they think, what is the intrinsic value for these companies for the next 12 months? And fair valued, basically the price they think the stock price should be. So that is the basic things that we're looking for. And the first company that we're looking at today is EOG Resources. This is one of the oil companies, 68.4 billion market cap. It has a narrow economic moat, $117 per share right now. Dividend yield of 3%, which is quite nice. Payout ratio, we're looking about 29%. Latest increase was 10%. The 5-year growth rate of 33%. In terms of dividend streak, is 6 years of increasing that dividend. Again, this 33% is huge, but they have only been paying that dividend for the last 6 years. So be mindful of that. And then the annual payout is $3.64. Safety 82%, profit margin 32%, return on equity 28%, almost 29%, return on invested capital 25%, free cash flow right now $5 billion in the bank. Total return in the last 10 years only 4%. Growth estimate for the next year about 8%. And then after that, they're expecting the earnings to grow about minus 1%. Not grow, actually decline by minus 1%. Again, this can easily change if the economy changes, if the OPEC comes out and basically increases the prices of oil, and demand basically is high and supply is low, or whatever, the oil prices go up, these companies' stock goes up, like what we've seen in 2022. Morningstar valuation right now says 9% discounted, $129 per share is where they think the price should be. Right now is $117 per share. Just before we move on to Nestle, I just want to show you very quickly, the company year to date is actually down about 2.8%. And when you look at the revenue growth for the next few years, as you can see here, 2022 they did really well, but that's the year oil prices went up to of course about $100 per barrel something, so for that reason the stock went up quite a bit. It has come down since then, 23%, $23.27 billion of revenue for basically in 2023. 2024 they're expecting about 24.3. 2025 they're expecting 25.1. 10, sorry. Okay, so it is coming back. And then when you look at the revenue, if we take out the estimates, you can see there was a bit of a decline, and then next year it will bounce back again, and it will go back to at least to $12 per share, which is nice to see. And the next company, like you've already seen, is Nestle. This is one of the companies that we have not spoken much of. If you have asked me recently, and I'm going to do a whole video inshallah on this one, but right now let's talk about this company. Market cap $279 billion. I'm sure you know this company. They sell all sorts of products. If you Google their products, it's absolutely crazy. Moat is right now, why the economic moat price $107 per share. Dividend yield of 3.2%. Payout ratio 65%, which is slightly higher than I like. Latest increase was 1.7, and the 5-year growth rate 4%. Dividend streak of 23 years of increasing that dividend. Annual payout, I don't know if this company is on the S&P 500, and if it's not, of course it's not going to be a dividend aristocrat, because the requirement is they have to be in the S&P 500, and it has to be basically increase that dividend 25 years or more. Annual payout $3.40, safety 99%, profit margin of 12%, return on equity 29%, and return on invested capital of 17%. $11 billion of free cash flow right now. This is in US dollars. Okay, changed it from basically another currency. Total return in the last 10 years, we're looking at about 6%. Growth estimate for the next year, I couldn't find that on Yahoo Finance. Growth estimate for the next 5 years, they're expecting about 8%, and then 14% discount right now. $124 per share is where they think the price should be. Next company we're looking at today is AstraZeneca. But before we do that, we're just going to look at the year-to-date return of this company, about 7% down since the beginning of the year. And when we look at the revenue side of it, it's been growing nicely, but 2024 they're expecting a bit of a decline from $110 billion to $107 billion. Then it bounces back to $111 billion, which is quite nice to see. And the next company is AstraZeneca. This is one I do own in my portfolio. Is one of the biggest companies in the UK. 203 billion market cap. So we are looking at the US ticker. So it's easier to find information on that one. So it has a wide economic price right now, $66 per share. Dividend yield of 2.15. Payout ratio 40%. Latest increase, although it says it hasn't increased, it does increase it. I'm using Simply Save dividend for this reason. But I think they have increased that dividend for the last 10 years. Okay. So dividend streak for basically increasing that 10 years. The annual payout is $1.42. Safety 70%. Profit margin of, in fact, you know what I'm going to do now? Let me check this. Okay. Okay, so I was checking how much of the UK version of it. I think I got paid about £15 for 21 of the shares that I own, so it kind of works out the same. Safety 70%, profit margin 13%, return on equity of 15%, return on invested capital 15%. Free cash flow right now we're looking at $6.5 billion, which is quite nice. This is US again. Total return the last 10 years 9%. Growth estimate for the next year 13%, then 13% every year after that. This is why I'm bullish on this company. This is why I'm still buying it. This is why I still basically I want to buy more of this company. 15% discounted right now. $78 per share is where they think the price should be. And seeking alpha, it's buy for all of them. And when we look at the price estimate, so the revenue side of things, okay, as you can see, it's heading the right direction from $45 billion to $50 billion and then to $54 billion, which is nice to see. If we change this to annualized and then take out the estimation, you can see it was heading the right direction. with the estimation is still heading the right direction, which is quite nice to see. This is why I'm bullish on this company. So let's move on to the two more companies. Next one is Nike. Nike is one of the companies that I had in the portfolio, sold it not long ago, took some profit and basically added that money to another company. $149 billion. I bet you've got million products this company basically created. So this is one of those biggest companies out there. Moat right now is a wide economic moat, price $98 per share, dividend yield of 1.5, payout ratio 41%. Latest increase was almost a 9%, 5-year growth rate of 11%, 21 years of increase in that dividend, annual payout of $1.48, 99% safety, profit margin 10%, return on equity 36%, and return on invested capital of 21%. $6.3 billion of free cash flow right now. Total return in the last 10 years 10%, 18% expected to grow the earnings about 18%, then 13% after that, 28% discounted right now. $136 per share is where they think the price should be. Again, according to Wall Street, it seems it's a buy. Looking at the basically revenue side of things, so right now $51 billion, 51.22, next year 51.82, so it's slight growth there, and then 55 the following year, so which is basically means it's heading the right direction. And if we take the estimates, you can see there was a bit of a decline in 2023, and that's why the stock went up quite a bit. But then in terms of EPS, is going up again into the right direction, so which is quite nice to see. And final company is probably one of the biggest in here. That's Taiwan Semiconductor. We know one of the biggest companies out there. None of the chips that we use in our devices, cars, all of these things will be made without this company. This company is based in Taiwan, and they're the main company that produces all the Nvidia stuff they coming up with right now. This is the company that produces. Okay, $626 billion, has a wide economic moat, $156 per share, 1.4% of dividend yield, payout ratio 41%, and 17% increased recently. 5-year is 10%, and dividend streak of just 1 year. Annual payout $2.23. Safety 62%, so above that safe. Normally, remember the safety measure is 761 and above. Profit margin 38%, return on equity 25%, return on invested capital 21%, and free cash flow right now we're looking at about $16.5 billion. Total return the last 10 years 24%, growth estimate for the next year 22%, and then after that is only 4%, which is very, very strange. Fairly valued right now, $151 per share is where they think the price should be. 156 is where it's at. And looking at Seeking Alpha, you can see a year to date is up 47%. But check this out. Seeking Alpha is saying, analyst is saying is a buy. Wall Street is a strong buy. Quant is actually saying is a strong buy as well. 4.9, 4.5, which is absolutely huge. Now looking at the revenue side of things, okay, you can see it's heading the right direction from $70 billion to $84 billion to $100 billion the following year. If we look at the annualized, you can see it's heading from $6 to $6.27 to $7.71 basically for the following year. That's the 5 companies I want to share with you guys. Some of these companies are absolutely huge. As always, do your own research. But before we move on, I'm going to show you the Sharia compliance side of things. You can pause the video. So there's no actually huge issues. Nestle is the only one that has higher interest bearing debt, but the rest of them are absolutely fine. 5 great companies in my opinion. The only one I own is AstraZeneca. I would actually buy this one, Taiwan Semiconductor, in a heartbeat if I could buy it in an ISA account, but unfortunately in the UK I cannot buy that, so I'm just going to leave that out for now. I did own it at one point on my free trade account, but I've sold it since, of course, and closed that account. So yeah, there you go. That's the 5 companies I wanted to share with you guys. If you have any other companies you would like me to look at, let me know. Put it on the comment section. I will be answering, inshallah, some of your comments very soon, because I know a lot of you have been asking questions and so on. I haven't had the time. I've got barely any time to produce those videos, let alone anything else. And I appreciate every single one of you guys out there. And I would really genuinely appreciate if you could just like the video. If you don't want to do anything else, basically do that. If you want to join us to the Patreon account, that would be absolutely wonderful, and it definitely helps the channel. Have a wonderful day. Assalamu Alaikum.